Hey, welcome to the Uncle Starts FIRE channel, where I record my FIRE, or financial independence retire early journey as a 45-year-old, to show everyone, especially the uncles and aunties, that no one is too old for FIRE, and it's never too late to start investing. Before I go into today's video, this uncle would like to once again thank everyone for your support for my channel. We have now more than 100 subscribers. My friends have been cheekily congratulating me, and I have to treat them copy several rounds. But I told them we are just starting. I hope to continue to produce good quality videos that will be useful for you, as we continue to learn from each other, and proceed on our FIRE journey, towards our financial goals and objectives. Okay, let's get into today's video. It is time for the main feature of this channel, that is, a monthly series of videos on what are the shares that I have invested in for my dividend portfolio. The purpose is to offer a picture of what this uncle does to build up my retirement investments, as part of my FIRE journey, and to provide an introduction and my views on these shares or REITs. To quickly summarize how this uncle is investing for the dividend portfolio, every month, I will choose about 4 dividend shares, or REITs, which I think are most attractive, and do dollar cost averaging for them. I will try to rotate around the shares I own in my purchases. This means not buying the same shares consecutively over too many months, in order to maintain diversification in my portfolio. Share investments in March 2023. In March 2023, I did dollar cost averaging on 3 shares and REITs. One of my investment is not listed in Singapore, but recently invested a lot of money in a portfolio of Singapore properties. I invested in number 1, Digital Core REIT, number 2, Link REIT, which is listed in Hong Kong, and number 3, ARA US Hospitality Trust. This uncle selected these 3 REITs to invest in March, as their market prices presented attractive opportunities for purchase, either because of price declines which I think are unjustified, or rare rights issuances at low prices. Digital Core REIT. The REIT I purchased in March that I wanted to focus on in today's video is Digital Core REIT, or DCRU, the only pure-play overseas data center REIT with underlying data centers in the US, Canada and Germany. I talked about DCRU in my previous video on what REITs would be good to hold during times of high interest rates. See link above if you have not watched that video. DCRU Introduction. DCRU's underlying properties are data centers, which is one of the hottest sectors in the past few years. Unlike offices which are occupied by office workers, these data centers are like warehouses or industrial properties which are largely occupied by computers and servers, connected to the internet all the time. Such data centers are critical nowadays, as everyone everywhere is using cloud in some ways. Businesses store their data in the cloud, with easy access by their employees. Individuals buy cloud space to store their personal stuff. I would think that the demand for data centers will continue to increase, even though we have been hearing news about US tech companies laying off workers, such as Facebook or Meta, Amazon. This does not affect the demand for data centers. I mentioned that Digital Core REIT has a low gearing of 34%. It used to have lower gearing at 26%, but recently taken on more debt for 1, acquisition of data centers in Germany using debt only, and 2, undertook share buyback using debt, as the share prices are much lower than its NAV. DCRU has fixed the interest rates for 75% of its debt. In addition, the earliest its debt matures is only in 2025. In their recent financial reports, Their financial year 2022 distributable income was 5.8% below forecast at IPO because of higher interest expense. Going forward, this uncle thinks that the impact of higher interest rates will be lower. One research analyst estimated their average interest rate will only increase from 3.9% currently to 4.0% by end of 2023. In addition, this uncle likes the rental structure of DCRU very much. The rental contracts always include a fixed rental escalation of 1% to 3% per annum, which provides stability and growth to their earnings. What I also like about the rental contracts is that the tenants are paying for the utilities. This is unlike the rental structures in Singapore. For DCRU, this means that any increases in electricity prices is borne entirely by the tenants. You can imagine that data centers use a lot of electricity all the time. This is because all these servers and computers taking up the space in the data centers, they need to be switched on all the time. 24 hours a day, 7 days a week. So electricity price increase was a major concern. Finally, the sponsor of DCRU is Digital Realty, the biggest data center REIT listed in the US. It has 291 data centers in 24 countries, and Digital Core REIT has a global right of first refusal on its data center pipeline worth $15 billion. So basically, DCRU is a REIT sponsored by another REIT, albeit a large and reputable one. We have also recently seen how the sponsor is willing to quickly lend a reassuring hand. When one of Digital Core REIT's major tenant, SunGard, filed for bankruptcy in April 2022, the sponsor immediately stepped in with an agreement in principle to guarantee the cash flow to Digital Core REIT in the event of a near-term cash flow shortfall. This reassured the market. So Digital Realty is another REIT sponsor that this uncle likes. Reasons for purchase. During the month of March, DCRU's share price dropped from about 60 cents to as low as 41 cents. This is a very big drop of about 30%. Comparatively, DCRU's US-listed parent Digital Realty went down by about as much as 12%, before recovering little to end down by 6%. In addition, Singapore-listed Keppel DC REIT went up by about 5%. I think there were 3 reasons for DCRU's price drop. They are, firstly, continued layoffs by technology companies, such as Disney, Roku, Accenture, etc. This may have further affected confidence in data centers' future performance. Secondly, impact of the US banking crisis in the middle of the month, where Silicon Valley Bank or SVB collapsed. Investors might be concerned that DCRU's banks or customers may be these banks, or somewhat affected by the mini-crisis. The REIT announced that it does not have any money deposited in these banks, or customers in the financial services or technology industry affected. Thirdly, investors might be concerned that its second largest tenant, Cyxtera Technology, seemed to have some troubles refinancing its debt. It asked lenders to push back the maturities of its debt obligations, and Moody's downgraded its credit rating to very low. Moody's said that its business fundamentals are okay, but they are concerned with its ability to service debt obligations in the medium term. This news may be more substantial, as Cyxtera Technology accounts for about 23% of DCRU's revenues. However, this uncle thought it may not be so bad. This is because Cyxtera is still current on all its rentals, and DCRU should have a few months' rental deposits as further buffer. Then there is the potential for the parent to step in with a guarantee on DCRU's cash flow, just like what they did in April 2022. Finally, I think that the demand in the data centers markets in the US is still strong. DCRU already managed to backfill about half of the space left by the earlier bankrupt tenant. So even if Cyxtera technology goes belly up, DCRU should be able to find tenants to fill up the space rather quickly. As a result of the share price correction, the dividend yield, based on financial year 2022 distribution of 3.98 cents, is about 9%. Just a year ago, the average dividend yield for data centers must have been 3% or even lower. This is very attractive, even though there may be risks in the horizon. So this uncle decided to enter to buy some DCRU shares in March 2023. Link REIT. The second REIT I bought was Link REIT. If you are not familiar with Link REIT, this could be because it is listed in Hong Kong, rather than Singapore. However, it is the largest REIT in Asia. Imagine even bigger than CapitaLand REITs. Its underlying properties are largely in suburban shopping facilities, such as shopping malls, but also smaller scale shopping centers, which I understand can be the equivalent of the wet markets in Singapore. This makes their revenues and distributions very resilient to downturns, including during, wait for it, COVID crisis, as everyone still need to make their daily purchases. Practically, they were impacted, but the impact is really small. Recently, they decided to expand their footprint to Singapore. Yes, you may have recalled it now. They are the purchaser of the property portfolio that NTUC was trying to sell. The portfolio is worth Sing $2.5 billion and include Jurong Point and Swing By at Thomson Plaza. So they are now a semi-Singapore REIT. Haha. Link REIT took the opportunity to issue more shares via a rights issue at Hong Kong $44.2. This is a very attractive price indeed. During the COVID days, the share price only dipped slightly below Hong Kong $60. In fact, the last time the REIT price hit Hong Kong $44, it was in 2015. So this uncle took the opportunity to subscribe for my rights, and subscribe for excess rights. Hopefully I will get some. That's a wrap. This has been my video on the dividend stocks and REITs that this uncle did dollar cost averaging on in March 2023, and a specific focus on Digital Core REIT, since there has been a lot of concerns in the market about DCRU. Just a reminder that it is this uncle's investment philosophy that both dividend shares, and also growth shares, have important roles to play in an investment portfolio, in order to be able to meet our objectives of retiring early, and retiring well. So although this video focused on dividend shares, we must not forget to invest in growth as well. I hope you like this video. Be sure to like, and subscribe to this channel, so that you will not miss future videos about my journey, and my portfolio. Bye.